They changed the rules over a weekend, while you were not watching, while the markets were closed, while the financial press was running weekend features about consumer confidence and housing starts. The most significant regulatory change to the American banking system since the post-2008 Dodd-Frank reforms was quietly implemented between Friday's close and Monday's open, the specific timing chosen with the deliberate precision of people who understand that policy changes of this magnitude generate less scrutiny when there is no open market to immediately price their consequences. The Federal Reserve, the Office of the Comptroller of the Currency, and the FDIC, the three primary regulators of the American banking system, jointly announced a modification to the Supplementary Leverage Ratio that changes the fundamental capital mathematics of every major American bank simultaneously. The SLR is not an obscure technical footnote in banking regulation. It is the foundational constraint that determines how much risk America's largest banks can take with the deposits of ordinary Americans. It is the lever that sits between the banking system's appetite for leverage and the depositor's exposure to that leverage. And it was just moved quietly, over a weekend, in a direction that benefits the banks enormously, and exposes the financial system to risks that the post-2008 regulatory framework was specifically designed to prevent. This is not regulatory fine-tuning. This is the financial system's equivalent of removing the safety mechanisms from a machine that previously destroyed the global economy and required $4 trillion in emergency intervention to restart. And the reason it was done over a weekend, the reason the announcement was timed to the precise window of minimum market scrutiny, is the same reason every consequential financial policy change that transfers risk from powerful institutions to ordinary citizens has always been implemented in the specific moments when ordinary citizens are least able to respond. The empire takes what it needs, and it always does it when you are not watching. Let's establish exactly what the supplemental leverage ratio is and why its modification is the most consequential banking regulatory change in a decade. Because the technical complexity of banking regulation is not accidental. It is the primary mechanism by which changes of enormous financial consequence are implemented without generating the public understanding that would produce political resistance. The SLR requires the 8 largest American banks, JPMorgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, Bank of York Mellon, and State Street, to hold a minimum amount of high-quality capital against their total exposure, not risk-weighted exposure, total exposure, every asset, every derivative, every off-balance sheet commitment. The SLR's critical feature is that it does not allow banks to reduce their capital requirement by claiming that an asset is low risk. U.S. Treasury bonds, the safest asset in the world according to every risk model, count the same as a junk bond for SLR purposes. This feature was not an oversight. It was the deliberate design choice of post-2008 regulators, who understood that risk models fail catastrophically in systemic crises, that the assets rated safest immediately before every financial crisis are always the assets whose failure produces the most damage when the crisis arrives. The weekend modification excludes U.S. Treasury securities and Federal Reserve deposits from the SLR calculation. This single change, technically described as a temporary exclusion with a review period, which is regulatory language for a permanent change that needs political cover, immediately frees up an estimated $2 trillion in balance sheet capacity across the 8 affected institutions, $2 trillion of additional lending, trading, and derivatives capacity that these banks can now deploy without holding the capital buffer that previously constrained them. $2 trillion of additional leverage in a banking system that is already carrying $180 trillion in notional derivatives exposure and $11.6 trillion in assets against a capital base that was already considered by many analysts to be insufficient for the risk concentrations actually present on these balance sheets. The official justification for the change is Treasury market liquidity. The $28 trillion U.S. Treasury market, the largest and most important financial market on Earth, the foundation of every dollar-denominated financial instrument globally, has experienced multiple episodes of severe liquidity stress in recent years. March 2020, September 2019, October 2014. Each episode saw the market that is supposed to be the world's deepest and most liquid financial market seize up, bid-ask spreads widening to levels seen only in financial crises, primary dealers unable to absorb selling pressure, the Federal Reserve forced to intervene with emergency purchase programs to prevent a complete market function breakdown. The official explanation for these episodes is that the SLR constraint prevented the largest banks from deploying their balance sheets to absorb Treasury selling pressure during stress periods, that the capital requirement by limiting banks' ability to hold Treasuries as a buffer was paradoxically making the Treasury market less stable. This explanation is partially true, but it is less than half of the actual truth. The other half, the half that the weekend announcement was designed to obscure, is that the Treasury market is experiencing structural liquidity problems because the supply of Treasuries has grown faster than the market's capacity to absorb them. The United States is issuing approximately $2 trillion in new Treasury debt annually to finance its deficit. The primary dealer system, the 24 financial institutions authorized to participate directly in Treasury auctions, has finite balance sheet capacity to absorb that issuance. When that capacity is approached, liquidity stress appears. The SLR modification increases that capacity, but it does not solve the underlying problem. It defers it, at the cost of increased systemic leverage. And deferred problems in financial systems do not resolve. They compound. The specific financial nuke hidden inside this seemingly technical regulatory change is its interaction with the commercial real estate stress, the derivatives book concentration, and the regional bank fragility that already exists in the system. The 8 banks affected by the SLR modification will not use their newly freed $2 trillion in balance sheet capacity conservatively. Banks do not accumulate freed capacity and hold it idle. They deploy it in the highest returning available uses, which in the current environment means leveraged lending, commercial real estate bridge financing for borrowers who cannot refinance at current rates, and structured credit products backed by the exact asset categories that are currently experiencing the stress that is driving those returns higher. The SLR modification frees up $2 trillion to be deployed into the most stressed parts of the financial system at the moment of maximum stress. This is not a stability measure. This is the financial equivalent of addressing a structural fire by removing the sprinkler system and hoping the fire burns itself out before reaching the load-bearing walls. The pattern of regulatory relaxation implemented at the precise moment of maximum financial system stress, justified by the immediate liquidity problem it appears to solve while creating the systemic leverage accumulation that produces the next crisis, is one of the most reliably documented patterns in the history of financial regulation. It has appeared before every major banking crisis in the modern era, with a timing precision that suggests institutional learning has failed completely despite the painful lessons each cycle generates. Study the Gramm-Leach Bliley Act of 1999. The Depression-era Glass-Steagall Act had separated commercial banking from investment banking since 1933, the regulatory response to the speculative excesses that contributed to the 1929 crash, and the banking collapses that followed. The separation was not perfect. It was not without economic cost. But it performed one critical function with reliable consistency for 66 years. It prevented the deposits of ordinary Americans from being used to fund the speculative investment banking activities that generate enormous returns in bull markets and catastrophic losses in bear markets. The Gramm-Leach-Bliley repeal eliminated that separation. It was justified by arguments about financial innovation, competitive necessity, and the sophistication of modern risk management tools that made the Depression-era restrictions obsolete. 9 years later, the financial system that Gramm-Leach-Bliley helped create required $700 billion in TARP funding, $4 trillion in Federal Reserve emergency asset purchases, and the deepest recession since the Great Depression to prevent complete collapse. The regulatory relaxation that was supposed to make the system more efficient made it more fragile. The efficiency gains were captured by the institutions that lobbied for the change. The fragility costs were absorbed by the taxpayers who never voted for it. The weekend SLR modification is Gramm-Leach-Bliley, with a smaller font and a more technical justification. The structure is identical, a regulatory constraint designed after a crisis to prevent the leverage accumulation that caused the crisis is being relaxed on the grounds that it is creating inefficiencies in normal market functioning. The relaxation is justified by arguments about market liquidity and competitive necessity. The institutions that benefit from the relaxation are the same institutions that lobbied for it, and the systemic risk created by the relaxation will be distributed across the depositors, the taxpayers, and the pension fund beneficiaries, who will bear the consequences when the leverage that the relaxation enables generates the losses that the constraint was designed to prevent. The deeper historical force operating beneath this specific regulatory change is the iron law of financial regulatory capture, the process by which the institutions subject to regulation gradually acquire sufficient influence over their regulators to convert the regulatory framework from a constraint on their behavior into an instrument of it. This process has operated in every regulated financial system in recorded history. It operated in the banking systems of Renaissance Florence, where the Medici family's relationships with papal financial authorities shaped the regulatory environment for their banking competitors. It operated in the British financial system of the 18th century, where the Bank of England's relationship with the Treasury allowed it to maintain monopoly privileges that served its shareholders at the expense of the broader financial system. It operated in the American financial system of the 1990s and 2000s, where the revolving door between Goldman Sachs and the Treasury Department produced the deregulatory environment that made 2008 possible. The weekend SLR modification is the product of this same process operating in the current regulatory environment. The Federal Reserve's board includes governors with backgrounds at the institutions affected by the SLR. The Treasury Department employs advisors whose previous and future employment is with those same institutions. The OCC and FDIC are staffed at senior levels by individuals who have spent careers in the banking industry whose capital requirements they are now modifying. This is not corruption in the legal sense. It is the systemic operation of an incentive structure that guarantees regulatory frameworks will drift toward the preferences of the regulated over time. that the constraints designed after each crisis will be relaxed before the next crisis, that the capital buffers rebuilt after each collapse will be redeployed before the memory of the collapse is sufficiently vivid to generate political resistance to their depletion. The hidden financial force that makes this cycle self-perpetuating is the explicit and implicit government guarantee that the largest banks carry. The too big to fail designation, which was supposed to be eliminated by the Dodd-Frank Resolution Authority framework, has not been eliminated. It has been reinforced by every emergency intervention since 2008 that demonstrated conclusively that the government will not permit the failure of systemically important financial institutions regardless of the regulatory framework nominally in place. This guarantee creates a massive subsidy for leverage. If you are guaranteed that your downside is limited by government intervention, you will take more risk than your capital structure alone would support. The SLR was one of the few post-2008 constraints that partially offset this leverage subsidy by requiring capital against total exposure regardless of risk weighting. Its modification removes a significant portion of that offset. The largest banks now face even less constraint on leverage than they faced before the weekend, with even larger implicit government guarantees than they held in 2007, with even more complex derivatives books, with even more concentrated counterparty exposure, and with even less regulatory capital standing between their risk appetite and the deposits of ordinary Americans. Watch 5 developments in the next 90 days that will reveal whether the weekend policy shift was a genuine stability measure or the opening move of the next leverage cycle. First, watch the primary dealer Treasury auction participation data published weekly by the Federal Reserve. If the SLR modification produces the Treasury market liquidity improvement that its official justification claims, primary dealer bid-to-cover ratios at Treasury auctions should improve measurably within 30 to 60 days. If auction participation does not improve despite the $2 trillion in freed balance sheet capacity, it confirms that the liquidity problem is structural, a supply-demand imbalance in Treasury issuance that leverage capacity cannot solve, and the SLR modification will be revealed as a bank profitability enhancement rather than a market stability measure. Second, watch the leverage ratio disclosures in Q2 bank earnings reports. The 8 affected banks will disclose their actual leverage ratios, the ratio of assets to equity, for the first time after the SLR modification takes effect. If leverage ratios increase materially, if the freed balance sheet capacity has been deployed rather than held as a prudential buffer, it confirms that the modification has increased systemic leverage rather than redistributed existing leverage more efficiently. Leverage ratio increases of more than 5% across multiple institutions simultaneously would represent the fastest single-quarter leverage accumulation in the post-2008 banking system. Third, watch congressional hearing schedules on banking regulation. The weekend timing of the announcement was specifically chosen to minimize congressional scrutiny. If the Senate Banking Committee or the House Financial Services Committee schedules a hearing specifically addressing the SLR modification within 60 days, it signals that the political resistance to the change is sufficient to generate at least oversight pressure, if not reversal. No hearing within 90 days means the change has successfully avoided the political scrutiny that its consequences deserve. Fourth, watch the credit default swap spreads on the 8 affected banks. If the market's assessment of these institutions' default risk declines following the SLR modification, if CDS spreads narrow, suggesting the market views the change as genuinely stability enhancing, the official justification has some support in market pricing. If CDS spreads remain flat or widen, if the market prices the additional leverage as additional risk rather than additional stability, it confirms that the modification has transferred risk from bank balance sheets to the implicit government guarantee that taxpayers ultimately back. Fifth, and most critically, watch the Federal Reserve's own financial stability reports for any acknowledgement that the SLR modification has increased systemic leverage concentration. The Federal Reserve publishes a financial stability report twice annually that is supposed to provide an honest assessment of vulnerabilities in the financial system. If the next report published after the SLR modification takes effect does not specifically address the leverage implications of the change, it will be the most informative omission in the report's history, confirming that the institution that implemented the change is not willing to honestly assess its consequences in its own public risk assessments. Here is the final truth that every regulatory relaxation in banking history has eventually produced, and that this weekend's policy shift is now adding to a financial system that was already carrying more risk than its capital structure can honestly absorb. The rules that constrain banks were not written by academics or idealists. They were written in the aftermath of crises by people who watched the unconstricted system destroy itself and understood with painful clarity what specific constraints would prevent the specific failure mode they had just survived. When those constraints are relaxed over a weekend with technical justifications in the specific window of minimum public scrutiny, the failure mode they were designed to prevent does not disappear, it returns, with larger numbers, broader exposure, and more complex propagation pathways than the previous version. The weekend policy shift just changed the rules. The banks that lobbied for the change know exactly what they plan to do with the freedom it provides. The depositors whose money will fund the leverage those banks are about to accumulate had no vote, no voice, and no advance notice. And the taxpayers who will be asked to fund the intervention when that leverage generates losses that the capital structure cannot absorb were not consulted on a weekend when the markets were closed, and the financial press was writing about housing starts. The rules changed, the game remains the same, the house always wins, and the house just gave itself more chips.